Good afternoon, everybody, or wherever you're watching this webinar. I'm Mark Murphy, founder and CEO of Northeast Private Client Group, and I'm here today with our Chief Investment Officer, Chris Pike today. Just looking by the list of attendees, I think we know every one of you on this list. But just wanted to spend a little bit of time this afternoon with all the craziness and mishigas going on in the world. We wanted to spend a few minutes talking about tariffs, everything, everywhere, and all at once, and just try to give you a roadmap of what's going on and some thoughtful discussion. So welcome everybody to the people that have joined. And I want to start by turning it over to Chris. So Chris, the floor is all yours, my friend.
Well, thanks, Mark. Hello, everybody. So, just want to give you want to give everyone on the call a little broader understanding of how we want to go about doing this. We really want to talk about the salient issues that have really been impacting capital markets. So you're going to hear Mark and I, really two guys, fireside chatting this, discussing what we think's going on in the world. And quite frankly, you may or may not hear differing views. We haven't scripted this out. We haven't practiced this. We were just coming from another meeting, he and I, and we wanted to get here in time to talk to all you folks. But as Mark pointed out, we put a note out. I believe it was last week, and it was entitled "Tariffs: Everything, Everywhere, All at Once." And in that note, we outlined at least what we felt was impacting the broader capital markets at the time. And it is an understatement to say what has happened over the last 24 hours is truly remarkable. This morning we're starting to see, or this afternoon, depending on where you're calling in from, we're starting to see some more volatility in the market. I was prepared to say something like, "Hey, maybe we should have waited another day, and the markets would have been up another 8 or 9%." But I think what's happened over the course of the last several weeks, we're starting to realize that volatility is here to stay. But really, going back to the point about the webinar here, tariffs. Clearly, the U.S. stock market has voted. The global capital markets or equity capital markets vote, and they don't like tariffs. I think what's happened over the last couple days, at least from my perspective, Mark, is that you had relatively lofty valuations going into the new year. And those lofty valuations were driven by a couple of things: pro-tax policies, or at least the expectation of pro-tax policies, a fair amount of expected deregulation, and pro-business expectations, right? So I think going into the year, a lot of folks really pumped up the balloon, so to speak. So going into this tariff salvo, capital markets were already stretched. And I think what everyone was waiting for was this ultimate tax deal coming down the road. And maybe what happened is that the script was flipped, and that we went to tariffs first, savings through Doge first, and then tax reform second. I don't know. You tell me. I know you talked to a lot of folks on K Street and some of your points of contact. What are your thoughts on that?
One of the things that I think you have to go back to is the most important thing to me, Chris, is emotional fitness. It's kind of interesting. I think that Marcus Aurelius had it right 2,000 years ago with Stoicism. In terms of that, we focus on the things that we can control, and we want to come away with some potentially actionable items. But I still think the world and the people, even on this call, see through things not through Stoicism or through an independent lens. They see it through their own political bias, meaning. As I said, half the people on this call think Donald Trump is a mad genius. The other thing, people think he's just mad. And there's no in between, and there's nobody in the middle on any of these things. And I think that the most important thing is that when people make emotional decisions around their money with their political bias, meaning I had my Republican friends, no matter what Joe Biden did and how that affected the stock market or real estate or interest rates in a positive way, the world was coming to an end. And I'm seeing the same thing now with Donald Trump. If you're an anti-Trumper, no matter what goes on here, you see it through that prism as well, even the good things as well as the bad things. And so I think emotional fitness is the most important thing. And I would also stress again that every time people say, Chris, that something is different, that it's different this time. What we really know is it's never different. It's always the same. It's just another version of what's happened before. And so I think one of the things we all can learn from that is when you make logical decisions and you make decisions from that strong basis, you're going to make the right decisions more times than not.
Yeah, no, I would agree with that. I mean, the one pushback that I would have is that, since Liberation Day, I think as it was coined, and that was April 2nd. So the day before Liberation Day to midday yesterday, the S&P fell 12%. So I think to a certain degree, capital market participants were caught a little off guard. And we talked a little bit about this in our note that we're not so sure if following the election and following the salvos into tariffs, if everyone was positioned that Trump was going to just use these as negotiating tactics as opposed to actually following through on them, if that caused him to dig in any deeper than he would have normally. Because I got to tell you, folks that I still talk to, on the street, and everything that I read and the research that I do, everyone's suggesting that, sure, we were expecting tariffs, but we weren't expecting tariffs to be this aggressive, and I think one of the big miscalculations in this was that trying to decouple Main Street and Wall Street was maybe a misguided error, because think about it this way. Apple is owned by probably almost, if the folks on this call have stocks, they probably own Apple in some way, shape, or form, right? Since Liberation Day to midday yesterday, Apple was down 23%. And this is where, I not only have one, I have two, right? You too. So my point is Main Street is very connected to Wall Street, especially if you think that, I don't know, between 55, maybe a little over 55, 60% of the US population actually owns stocks or equities in their retirement accounts or their individual accounts. So that's
Chris, I think, a lot of people here are really into the weeds on, let's start with tariffs, and we can go to other things. And then some people, we just kind of level set about, what's the gambit here? Why did we put these tariffs? Please explain to people what the issue is, because I'm sure not everybody is clear on the issue. It also depends on the news source you get it from.
Yeah. So I guess the whole idea was part of the administration's four-pronged approach to their policy was to right-size trade and commerce. And by doing that, by instilling tariffs, it's whether it's bringing or onshoring industry, whether for profit or for national security, to bring capital or revenue into the coffers. You name it. There's a myriad of reasons why why this was done. But for the most part, if we take a step back, come Liberation Day, it started off as a 10% across the board tariff on all imported U.S. goods. Now, there were some exceptions between Canada and Mexico for certain items covered under certain agreements. But then for other countries, there was also the expectation of bilateral tariff agreements or negotiations. Clearly, I think everyone's been following the news. I think our effective tariff rate on China now is 124% after the back and forth salvos. But once again, it was meant to, depending on, once again, who you listen to, what news station you watch, right size trade and commerce. Because I think even if you go on a conservative news station, they'll run clips of Nancy Pelosi and Chuck Schumer basically saying similar things that Donald Trump's saying, but maybe not as aggressive. And they keep running these reels. So I agree.
Chris, would it be fair to say to this group that the current administration has basically said to all of our trading partners, if we want totally fair and free trade where you can move your products into our country, we want to have the same access to your country. And so we either have free trade or we have reciprocal taxes where we tax you at the same rate that you tax us, to level playing the field so that the United States doesn't continue to get ripped off. And we're bringing not only more of the good paying jobs into this country rather than exporting them, but also bringing in, as you said, national security things like steel or like medicines or like computer chips or other things that would make us would be national security issues that we need to manufacture here. Would you disagree with that or add anything to that?
No, I think you have some valid points, but once again, I think our role here is not to litigate what is right and what is wrong. Our role here for our clients is to try to figure out what's the most probable outcome of what's happening. In other words, our job is to try to see around the corner, right? And say, okay, this is what we see happening. This is what we think the most probable outcome is, and this is how we should position client portfolios, and these are the kinds of convos that we should have with our clients. So once again, in a nutshell, tariffs were meant to right side international commerce and trade as it relates to the U.S. And we'll see where this goes from here. But let's make no mistake, it is impacting equity markets. And I think one of the more unnerving things for me, given my background, my fixed income background, REIT background, CMBS background, is the last thing I want to see is fixed income markets being negatively impacted by this, right? I mean, there was some, once again, depending on who you read, all plastered all over the news yesterday. Oh, China's going to start selling U.S. treasuries. That's not a good thing. Now, look, what people don't know is maybe the top 10 holders of, or the top 10 governments out there, they own about 15 to 17% of the U.S. debt. China owns 2%. Japan actually owns more U.S. debt than China. So once again, one of the more unnerving things that I've listened to over the last couple of days, and this is one thing we don't want to have happen. We don't want this to become a 2007 asset impairment issue. I'm okay with this being a 2001 recession or a 2020 recession where it is a revenue issue. I don't want it to be an asset issue, because if assets are impaired, that's when the fixed income market's going to take note. That's when the quote bond vigilantes are going to be awoken, and that's where we get some real serious chop. That's where we get some. But look, I think the bright side of all this is come yesterday, 90-day pause. 90-day pause. Everyone is basically right set back to 10% on tariffs, except for China. And also, I think what's helpful, at least from my perspective, from an economic perspective, is the CPI number this morning came in better than expected. Like, I was always expecting that. Well, tariffs are argued to be inflationary one on a one-time hit. In other words, you go today and avocado is $2.50. You go tomorrow, it's 20% higher. But then the rate of change of the price of that avocado shouldn't increase all that much. So today's CPI print, actually, both on the headline and the core, was helpful, because this does a couple things. If the capital markets continue to go sideways and continue to exhibit the volatility that they're exhibiting, this also gives Chairman Powell a little more cover if he was going to either put a protective put in, or if he was going to start cutting rates, starting in May or June. I mean, right now, markets are pricing in about 325 basis point rate cuts for the end of the year, and maybe 4 more in 2026. So the idea that CPI came in, and once again, that's not the primary litmus test the FOMC or the Federal Open Market Committee uses to determine whether or not they're going to increase or decrease the Fed funds rate. It's more the PCE deflator. I think that's a positive sign, because what we're now going to maybe potentially do is remove the S word from the conversation, stagflation. That's a bad thing. That's bad no matter how you approach that conversation.
It's the 1970s where we had stagnant economy and inflation at the same time. I think also, before you get specifically about what people should do or things are there, what our thoughts are, you got what we call black swan and white swan events, meaning the black swan events are you've got the U.S. government with aircraft carriers surrounding Iran, who are days, weeks, or hours away from nuclear weapons, which If quite frankly, if they have them, Israel may attack, and if they have them, they may attack Israel. So that's a black swan potential event. You're not hearing much about it anymore, but we're still working with the Russia-Ukraine situation. Does that war get stopped? And then people are always concerned about the Chinese invading Taiwan. Those are and tariffs clearly are right now a black swan event, and that it's disrupted not only the U.S. economy but the world economy. But the white swan events, and I want you to comment on that because there are a lot of white swan events out there as possible. It looks like we're going to see massive deregulation, which unleashes the stock market and unleashes profitability of the country. I want to take them one at a time. What do you think about the regulatory efforts and how that will affect what people do either with their real estate investments, their fixed income investments, or their stock market investments?
Once again, I think I know this phrase. You hate this phrase whenever I throw it back at you, but it depends. And you know me as the guy who's always trying to look at things in a balanced way. I really think it depends upon the regulation, um, and what the regulations ultimately intended to do. If it's ultimately intended to drive U.S. growth, whether it be employment growth or what have you, yeah, I think that's a positive. you know, um, there's always unintended consequences of that. If you remember back in the great financial crisis, at that point, everyone who wanted to buy a home should have a home. I think that was something uttered by Barney Frank, you know?
Mm.
So the point being is, while there was altruistic intent behind things, and there may be the underlying altruistic intent behind deregulation, let us not forget that there could be unintended consequences that could have a negative impact on growth. But by all means, I think and once again, let's be agnostic politically about this. If we have a more unrestricted, let's say, M&A environment, right? More transactions, more greasing of the track, so to speak. Um, that's a good thing. That's a good thing for retirement portfolios. That's a good thing for well-capitalized companies, because then well-capitalized companies can start buying, let's say, companies that may not be doing so well with their own currency, because now the M&A machine is working. And that's one of the things, once again, that's maybe what tariffs have kind of done, unintended consequences, caused some question marks down on Wall Street, whether you're JP Morgan, Goldman Sachs, Bank of America, of getting stuff done. But clearly, deregulation, tax reform, they're absolutely going to help out um, U.S. corporations. And to some degree, let's say if we even lower tax rates a little more, that could have a beneficial feedback loop to international companies who actually are still trying to put product in countries who are tariffing our goods, because now their tax rates are lower, but their tax rates are lower, their EBITDAs, their net income is greater, then they can basically go start to hire more folks, increase R&D, so forth and so on. So long-winded answer, it's a depends answer, but it really depends on what the deregulation is, what the consequences, either positive or negative, you know?
I'd also say
Um,
the other big white swan event, Chris, is this tax reform that
yeah,
where a couple of things that I see is if you believe the administration, there's a commitment of $7 trillion of investment in this country, which should not only bring some new jobs in this tax bill. The second thing is if they get through tax-free Social Security and no tax on tips, that should pour a ton of money into the economy of people that were giving that money in taxes to the government, that those people will spend that money and put it into the economy and grow it. And then the third is there's things like opportunity zones and accelerated depreciation and a lot of things in the economy that will spur investment. So if we get the right tax reform bill combined with deregulation, that should also be a white swan event as well. Comment on that?
that's No, like I said, I'm just going to go back to my previous comment. It all depends. It all depends on what the unintended consequences of those actions are. I mean, once again, it doesn't matter who you voted for last November. The deficit was going up. It was just a matter of how much, now. So if we, all else being equal, if we're looking at an $8 trillion deficit increase associated with no tax on tips, no tax on Social Security, all these other items, um, there needs to be pay first, right? Now, what third rail is going to get cut if there's going to be a third rail that gets cut? So the bigger problem, as I alluded to earlier, is when we start talking about debt upon debt upon debt upon debt, that's also going to wake up those bond vigilante hibernating bears. And you don't want to wake those folk up. You really don't. You want them to sleep through the winter, the spring, the summer, maybe come out a little bit between Labor Day and July 4th. Okay, come on out. Everyone's down the shore anyway. No one's going to pay attention to you. But you really don't want to wake up those folk. So, like I said, it's a concern. But to your point, growth begets growth. And so one of the only ways, and this once again doesn't matter who you voted for in November, ultimately the long-term solve for what we're going through right now is growth, is productivity. The only way we're going to get out of the deficits that and once again, it doesn't matter who you voted for, not only in November, but the last 25 years, everyone is going into that till. We got to grow ourselves out of here. And technology is the way that we're going to do it. And that's the one thing I did want to talk about is that we got a couple questions like, what do we do with the tech trade? Well, I don't think tech's dead. I think it's just taking a little nap here, right? And it's taking a little nap because think about where all the technology comes from. All the chips come from Taiwan, right? Sure, we're trying to build foundries here, but we're still a little beholden on this. iPhones are manufactured in China. So I think as we level set tariffs, as maybe as Bassett said yesterday, Treasury Secretary, Liberation Day was a ceiling. If that truly is the case, and if Trump can actually start negotiating bilateral trade deals, then technology CEOs will be able to better manage supply chain development, and so forth. And I think technology is going to come back because I honestly think technology has been on sale. Apple had its best day yesterday since 2021. So, like I said, interesting times on that part. I mean, Mark, let me ask you a
Chris,
question.
I think people have turned into this because I think it's such a fluid situation, meaning we'll know about Tax Reform Act for sure by the August recess, and we'll know a lot of the pieces that are coming out over the next 60 days. We're learning every day about what's being deregulated. This tariff thing will play out either over the next few weeks or hopefully a few months. If it goes more than a few months, there's a problem there, or some of these other global potential issues. But if you're sitting there right now, we like to do something very clearly. We like to buy low and sell high.
Yeah.
That is, and human nature, Chris, as wants you to buy high and sell low. Remember, people have FOMO. When the market's going crazy, people call us all the time and want to triple down on the market. And we go, hey, it's too late. And then when the market kind of hits the skids, some people call and go, oh, wow, it's a panic. I'm losing money. I better get out. And so it makes us emotion wants us to buy high and sell low, and we want to buy low and sell high. And I know we can't give advice out here because, hundreds of people or more are going to watch this and their situation is unique to them. So we can't give any specific advice. We'll be happy to give private advice to anybody who wants it, as we do every day. But what are your thoughts? Because people are asking me that question, asking you that question every day, and it's super fluid.
Yeah, I think a couple of things. I think investors and clients and whoever's listening on this call, I think folks need to be in store for accept continued volatility and shop. Once again, a lot of the initiatives that are coming out of 1600 Pennsylvania Avenue are driven by the notion that the midterm election marketing cycle starts very shortly, right? So the move fast and break things approach to a lot of things are being really moved into a microscope. And if history repeats itself, doesn't rhyme, what's the phrase? It never repeats itself, but it does rhyme. If we look back historically, midterm elections, the sitting presidents lost anywhere between 25 and 35 seats in the House. So who's not to say that that's not going to happen again? I would say good money is that, the House may be up for grabs. So that's why don't expect policies to change or approach to change. Hence, investors need to accept volatility, accept chop. But once again, to your point, we need to manage not what's going to happen between now and the passing of the omnibus reconciliation bill for taxes. But what we have to do is provide guidance and counsel to our clients based upon their specific needs, whether it's savings for their retirement, saving to put their kids through college. In the near term, we think because of the chop, what we've done, at least in our model portfolios and our ETF portfolios, we've done a couple things. We've underweight technology at large, in general. Hence, we're a little underweight technology relative to, let's say, an S&P 500, a Wilshire 5000, a Russell 3000, you name the broad equity index. We've overweight staples, those necessity type companies that you can't live without, regardless of what's happening in the broader economy. We've overweight healthcare. And look, there's going to be winners and losers even in the tariff conversation about healthcare. You could have health services companies do very well, especially with some of the increases to reimbursements that got pushed through a couple of days ago. Whereas, let's say, biotech companies may be put under the microscope, no pun intended here, a little more, given what's happening in that sector and how the administration is looking at that. So I think in general, we are, like I said, overweight healthcare relative to the S&P 500 or the broader equity indices, overweight staples, underweight technology. We were underweight this consumer discretionary, the cruise liners, the Teslas of the world. At this point, we are still, Polymarkets is still pricing in, I believe it's like a 50% probability of recession in 2025. Now, we always had baked in the cards for readers of our work. We always were, a contrarian in this, and we did a bunch of work reviewing other people's work going back through past recessions, and we felt as though that quote soft landing is a unicorn, and that we were going to eventually hit a soft patch. And in fact, the soft data that we've experienced over the last, call it 2 to 3 months, that's not a Trump issue. That's just the natural course of a cycle ending, right? So that positioning, or the positioning that we're in now, wasn't tariff related. It was more along the lines of, okay, we see a soft patch coming. We expect it based upon our research. Any ensuing recession is going to be short and narrow, or short and shallow. And the data is there. We can push up our 2025 outlook to the chat here for everyone to review.
Can I just ask Chris, or President, to cut you off? But I was saying to you, one of the things I think people are asking is people that have dry powder. I don't know if everybody knows what a dead cat bounce is, but when the market drops precipitously, people think, oh, it's a buying opportunity. A dead cat bounce means people buy for a few days, it rises, but then it goes to new lows. And so nobody wants a dead cat bounce. So when you do your analysis and your team is, in the weeds with our quantum analysis, when do people who have dry powder to put in the market? Because I think as a general rule, we want people to hold that. You don't sell your stocks when the market's off, the way it is now. Selling is not an option for many people, or for most people. But if people are looking to be more aggressive or to get back in or buy at lower valuations, how do you and how does your team, and how does our team go through the analysis of when's the right time? Because, quite frankly, it's an art, not a science. And there is a little bit of guessing and betting on that. So what is the process in place that people should be looking at to decide whether they should be putting more money at risk?
It depends upon how much liquidity you have and what your near-term, long-term goals are.
It's individual to them, but how do you think about it in a global way?
But I guess that's the rub, Mark. There's no one size fits all for everybody. So, for example, for some clients who have a fair amount of what we call dry powder on the sidelines because they were worried about the Hamas Israel war or Iran doing something crazy, and so we basically sidelined some cash. Well, if they don't need that cash for 5, 10, 15, 25 years. Maybe they're in the business owners who this is just the cash flow of their company that basically is going to be their grandchildren's capital. We've started to buy on these quote dips. I don't want to call them dips, but we put some money to work last week. Now, the way that our tea leaves, the way that we read our tea leaves is that, look, like I said, back to my recession comment, we thought we were going to maybe get to a modest recession. But even there, we do the math. If we're putting a 16 and a half multiple on a, I don't know, a $290 S&P 500, I think we can get down to 4,500 on the S&P 500 if it gets a little hairy out there. We don't think it's going to get hairy out there unless this becomes a debt issue, which I'm hoping and I'm seeing that it's not going to become. So for clients who don't have a need for capital in the very near term, sure, we're taking advantages of these sell-offs. It's no different than your 401k, right? You effectively dollar cost average into your 401k every 2 weeks by putting capital in, right? You put when valuations are high, you're buying less of that good or stock. When valuations are low, you're buying more. Over the long term, you're going to win. And I think that's the approach. If you're a client, let's say, Mr. and Mrs. Murphy come to me and say, hey, our twins are going to college in 18 months, and we have $400,000 in their 503 or 529 and 100% equities. Well, we're going to say, hey, maybe it's time to hit the eject button and go into something a little more conservative, right? So once again, it depends, and I think it's very client centric. But I think near term, cash is king. On the fixed income side, we're always going to love preferreds. From our perspective, we love yield. Preferreds are one of the most durable and predictable sources of income out there, understanding there could be fluctuation in the underlying value, but for the most part, these preferreds mature at par, not hardly any defaults. We like AI, we like technology. We think that's on sale right now, especially for longer term investors. That's like I said, it's very unique. It's very subjective.
The other thing too is I always say for people that are entrepreneurs, and that means whether they own a business or whether they are just entrepreneurial in their thought, which many of us on this call are. The best investments entrepreneurs make is when they invest in themselves, and there's no reason to procrastinate. And I think that everybody here on this call should have an unlimited appetite for investment in themselves, as long as they can get a minimum of a 4 or 5 to 1 return on their money or more. And the idea is that sometimes in these uncertain times we have paralysis where we just kind of freeze. And I think ultimately what I'd love to be able to talk to people about is where do they deploy capital to grow their business? As an example, if you're affected greatly by tariffs, maybe because you're importing goods from, let's say, China, Chris, well, it probably negatively impacts your business, but it might really impact your competitors' businesses because they've got debt. They're not as smart as you. They're not as well run. This may be an opportunity to go buy their business, go out and buy their business because it's in sad shape, or steal their best employees, or work on things to make your company not only survive, but when we come out of this, you're roaring like a V. Or trying to, as a person, if you don't have a business, is it time to invest in some technology or education or other skill sets, or building a network or things that will help you get there long term? I think that a lot of times, Chris, this disruption in the market is also times a distraction for people to either make poor decisions or to just be paralyzed. And I think that great fortunes are going to be made. Great fortunes in this country are going to be made because I know how you feel and I know how I feel, that opportunity is everywhere. And that every challenge is always an opportunity, and there's always a place to get to a bigger, better future. Yeah. And I think, part of it is you just need, that I think our number one job at this point is, I go back to my very first comment, it's to make sure that people are making wise decisions, that they are emotionally fit, and they have all the information necessary, not opinion or fact or hearsay, but enough facts so they can make the right decisions for their business, their family, and their and their children.
Yeah, no, I agree. I agree with everything you said. I mean, I think a couple other things, and then I just want to move to Q&A because we're approaching the hour. Um, you know, crypto, we've talked to a lot of folks about crypto. You know, for the folks who know me and know my biased view on crypto, you know, until you can start paying for your dry cleaning bill with cryptocurrency, to me, it's no different than a piece of art or a very expensive Ferrari. Um, while it's being more accepted, I still think its inability to inability to truly store value, especially over the last couple days, or hedge out equity volatility over the last couple days, like gold has been able to do, kind of should draw some questions. So, you know, I'd advise all the clients on the call or just listeners on the call to really think twice, measure twice, cut once when it comes to crypto in that regard. And that's, you know, to echo one of your points, Mark, you know, I'm not trying to quote Jim Cramer, but there's opportunity everywhere. I think part of our job also is trying to see around that corner. Like what's gonna be the trend in 5 or 10 years? Clearly, you know, we talked about sectors that we like and you know, underweight, overweight. Utilities, you know, utilities may be a great place to be, not because we like that 3.2% dividend yield, but because the grid is falling apart, right? We have AI who that needs massive amounts of energy. How do we get the energy to these data centers, right? For folks who follow data centers, incredibly difficult building to put up. You have to have the right land, you have to have the right piping. It takes a while for the entitlements to get through. How do you make all that happen when the grid is not great? Well, we start to look into, and once again, this may be a 2028, 2029 payday, but you know, are there alternative energy sources that could provide the energy that these data centers are going to need to drive the AI boom that quite frankly, this is the internet. This is 2000. This is 2000, right? We're just at the beginning of this, even with the deep seek pause and capex expenditure that a lot of folks are talking about, or even Microsoft pulling away from some leases. You know, utilities, energy, alternative energy. What can we do? And once again, like it, dislike it, politically agnostic. The aerospace and defense sectors, it's going to be a place to be. You know, some would argue the best thing that happened for Europe was Trump, in the sense is he's not only forcing a very austere country like Germany to start issuing debt, but he's forcing them to issue debt and their build up their military. So not only are we going to have to basically offset their military expense, but then we have to start buying some of their military infrastructure from our country, our companies. So I think there is a tremendous amount of opportunity out there. And it's one of the reasons why we work with all you folk is that we try to help you understand that. So look, we're at 110. I don't, do you want to try to move to some Q&A, Mark?
That sounds great to me.
Yeah, so I think, you know, I'm looking, so once again, we have the chat up, and if you want to just start putting some questions in the chat, we do have some questions from clients that were posted yesterday, but I'm just looking at the chat right now. One question I think you already posed to me was, you know, dead cat bounce. Yeah, sure. I think what's happening, once again, just to reiterate that, is investors are looking at some of the start stop policy communications at a 1600 and saying, okay, what's next? And I think what's happening is even some corporate CFOs and CEOs are saying, okay, I have to issue debt. What do I do? Do I do it now? Do I wait? Is there going to be a tweet in 24 hours? Do I have to wait 3 months or, you know, 90 days before the 10% tariff is not 10%? You know, do I wait, I don't know, 45 days and maybe we're that much closer to a reconciliation bill, or we get some more news on deregulation? I don't know. So I think there's a fair amount of uncertainty that's still percolating through capital markets that has maybe caused this little dead cat bounce downward after an eight to 10 point day, depending on what you were invested in yesterday. Another question here: how volatile, with all the volatility in the stock market the last 5 days, do you have any thoughts on portfolios insurance, like purchasing short ETFs in the event of a black swan event? Look, um, levered ETFs, especially triple inverse levered ETFs, are very risky investments because they reset every day. So the only way that you're going to get these inverse or levered inverse ETFs to work is if you are right every time you go back to the back to the cookie jar, so to speak. Someone very smart once told me that you don't have to be short a stock if you think it's going to go down. Just don't own it, right? So that would be some of my advice. Is once again, if you need capital, if you need to put your kids in you got to make that first college tuition payment in less than 6 months, then maybe you shouldn't be in an all cap growth 529 at this point, right? So, portfolios insurance is tough in that regard. Could you buy protective puts? Yeah, sure. Maybe you could buy protective puts. You get a little, you get a little income, but then once again, you're on the hook of the stock getting called away from you if we have a tweet in the middle of the day that sends Apple up 15%. So just be careful with that stuff.
Well, the other question I get asked, it's been asked 5 or 6 times in different ways. I'll try to do a fifer. But people that are on this call that are either retired or they're living off their assets. And so I say, one strategy that we would employ is the fact as the market descends, we'd like to not take money evenly from your portfolio. We'd like to take it disproportionately from secure things like cash value life insurance, like some secure bonds that don't have volatility, to give the stock market the opportunity to rebound. Because historically, at least, Chris, the market rebounds. You just don't want to have to sell. If you own good stocks and good companies, you just don't want to have to sell them when you need to sell them. You want to sell them when you want to sell them. Exactly. And so the shift is there. It was the reverse over the last couple of years as the market was raging, where we'd have people calling us saying, why are you disproportionately selling our stocks? Why wouldn't we take it from some of the lower yielding vehicles? And our answer always to them was, you told us you wanted to buy low and sell high, not buy high and sell low. And so, the idea is, if some of your favorite stocks are down 10%, 20%, 30% from highs, not only will we at some point, depending on who you are, consider buying more, but for those folks that don't have dry powder, do we just stop taking distributions from there, give them the 1, the 2, the 3, the 5 years to recover, and take that money disproportionately from fixed income? So that's how we would change your distribution strategy, as opposed to just taking things evenly across the board. And we're already doing that. We've got teams working on that long term to help you, and be happy to talk to you about that personally. But I hope that answers your questions. Because if you start pulling from stocks when they're low, that's a clear way to run out of money or to run into an economic problem. And so so not only did you want to do a great job when you accumulated these assets, but now we have to be extra vigilant in terms of having a really clear, crisp strategy to distribute that money. So we're not selling undervalued stuff that we know at least historically comes back.
Right.
In fact, just one last point is, I think in 2022, Chris, and I could be off a little bit, if you take, say, 2 of the biggest stocks out there, Apple, I think, was down 32%, and I think Tesla was down like 42 or 44%. And why, if you were retired or needed money, would you want to sell those companies off 30 or 40%? You'd want to cease all distributions, and you want to focus on taking that money from another pocket to allow those companies to come back. And thankfully they did. But that strategy is a continuous strategy that we just need to repeat. And so the devil in the science is in doing that properly.
Yeah. No, I agree with that. I think that goes into one of these questions here. It's like, this is coming from Michael V. How will tariffs, I'm assuming it's tariffs, impact markets long-term and short-term, and what should people do for short-term liquidity if they were market reliant? I think you spoke to that. If they're market reliant, maybe look at other areas to protect yourself from market volatility, because I guess in the industry we call it forced liquidation. We don't want forced liquidation, right? And that's something we definitely don't, because that's just a recipe for underperformance in the long term. I'm just going through some more questions here. Do you anticipate, this comes from Drew B. Do you anticipate further stock market declines, or are we near bottom right now? Look, I think, as I pointed out, I think right now, all else being equal, if we were to have a nasty, or not a nasty, but if we were having a traditional run of the mill recession, I believe a market bottom, we're probably about 500 points from a market bottom. Maybe we bottom out at 4,500 on these S&P 500. Um, to Mark's white swan commentary earlier in the day, or earlier in the hour, there are, and some people may say, Chris, you're Debbie Downer, you're only talking about the negatives. No, there are a lot of positive things out there. Unemployment claims are once again solid today. The employment numbers last month, albeit backward looking, were pretty good. You know, Folks have jobs. Retail sales. If we look at retail sales, people don't spend if they don't have the money, if they don't have the job to get the money. And you're starting to see, following the harsh winter months, retail sales, whether it be Red Book, or what have you, they're once again recovering. So I don't think we are going to have a 2008 great financial crisis type recession. I don't think that. Do I think it's going to be short and sweet? Yes. Can we get down to 4,500? My Costco crystal ball is as clear as anyone on this call. But like I said earlier, for clients that have excess cash for longer term goals, and they don't need to access that cash, we've started to put capital to work over the course of the last, call it, week or so. Some other questions
In a thoughtful way.
Yes. Oh, yeah. Well, aligned with, once again, and maybe this is law. Maybe I didn't articulate this. Everything we do is aligned to what we would consider a client's investment policy statement. So if a client is looking for durable, repeatable income streams, well, that's a strategy that we are employing for that client. If we have another client who has their first college tuition payment in 16 years, well, that's a different discussion, right? So in the latter case, sure, we would maybe take some capital and put it to work in these dips as we 401k buy down into a trough. Because remember, a bottom is not a point in time, it's a process. That's something everyone needs to understand. To try to bottom tick this, if I could bottom tick this, you guys wouldn't be talking to me right now. I'd be on some island somewhere in the Bahamas. Other
Here's a
questions.
question. It said, Mark, I knew you were smart. I didn't know how you were that good looking. No, actually, I wrote that question. I wrote that. That was a question I wrote. We'll go on to another question. I was going to say, seriously, I was going to say the other thing too is that with rates coming down, a lot of people are locked into long-term low fixed rate loans, which is amazing. Timed it right. But some people, I think one of the things we also want to talk to you about is at some point, do you have some loans that are coming off the fixed rate and could balloon, which would turn your cash flow upside down? Or on a positive note, are we getting to a place where we could really sit down and analyze your global debt and see if that we're close, or with the 2 or 3 rate cuts that are priced in, could we do a global debt restructure and actually increase your cash flow by being able to do a refi on both your business debt, your mortgage debt, your lines of credit, your student debt, taking a lot of that there's always opportunities that we want to look, not just make this, Chris, about the stock market, but make this about using this disruptible event to look at everything that's going on in your life and every opportunity and where you're spending your money, and looking at things on a hard basis. Because, obviously sometimes a lot of small changes added up can add into big changes. Like they used to say in the Pentagon, $1 billion here, $1 billion there, it starts to add up to real money. And so little moves with people. And I think one of the things, it's sometimes the devil's in the details. And I would welcome the opportunity to look at the micro details for everybody to see if we can make massive improvements by changing several small things, not just the big things. And I also think it's always about emotion and mentality. I always go back to it's always mindset. The only thing you can control is your state. And the thing that we learned from COVID, Chris, was that the people that were mediocre use COVID as an excuse why everything in their life and their business and their family didn't work. And the people that had the mentality that said, hey, this is a place for me to reset my life and to be able to create a bigger, better future for myself and everybody around me. Those people use COVID to turbocharge their lives. And I think it's the same thing here. It's that where is the opportunity in this? And this is what we look for every time. And this is what we, that's hard in a general sense to give specific advice to a general population. But we want to have those discussions individually with you. And we are here to help you. And by the way, all I want to tell you is that we always work really hard. We are working literally around the clock. Chris is in the lab with his team, all day, every day, making sure that we are making all the right calls, or doing our best to do that every single day. And I just want to acknowledge you and acknowledge how hard you've been working. And, I just could be prouder of what you and our team have accomplished, Chris.
I appreciate that. So we have 10 more minutes here, a little less before the hour. Let me try to bang through as many questions as I can right here. This is from Carrie C. How do we expect this I guess tariffs will impact consumer spending in the near term, specifically discretionary spending? Once again, my surprise is that retail sales rebounded. That was a pleasant surprise. I think some of it's revisionary in the sense that we had a colder than expected winter through certain weeks. And so when that happens, folks aren't out about buying things. So we're seeing a nice little bounce in spending. I mean, theoretically, tariffs could impact spending a couple different ways. You can see a lot of buy forwards. In other words, all of a sudden, folks going to Costco and stocking up on stuff. So you can see a really great number coming out of Costco this quarter, or maybe even Apple, despite having some of their supply chain issues with China. Folks may be going to the Apple store and saying, hey, I want to get an iPhone before it costs $2,000. So you can maybe see consumer spending turbocharged in the near term. But once again, that's where it gets a little murky because we don't know what the tariff environment's going to be like in 90 days. We don't know how the deregulation overlay or the reconciliation budget overlay is going to look out in 90 days. So that's why we're being very cautious with some of our commentary, but really, housing it in the notion that long-term, short-term goals and like I said, long-term goals, clearly some of these sectors are on sale. But I think discretionary spending, look, if we enter into a recession, even if it's a modest one, you're going to see discretionary spending come in a little bit. But let's see how the spring unfolds. What we're starting to see, albeit, let's say there's been a little pop up in like the 10-year, mortgage rates in general have been on a decrescendo. And we are now moving into the spring selling season for homes, at least in the area that I live. I don't know how many homes came on the market over the last couple of days. Now there's an affordability issue out there, and there's clearly a mortgage rate issue out there. But homes are still moving. And think about what happens when you buy a home. I remember I bought my first home in 1996. I had to go buy, the first thing I needed was one of those blue Rubbermaid recyclable bins. I didn't have that. Living in Hoboken, we didn't have that. So think about every time you own, move into a home, especially have an apartment, there's a whole plethora of things that you have to go buy, right? So I would argue folks who are going to be focused on discretionary spending, I don't know, walk into your local Home Depot on the weekend, see how much foot traffic there is, right? Or your Lowe's, see how much foot traffic there is. If you're starting to see more and more people pop up at Home Depot buying those blue Rubbermaid recyclable bins, that's a good thing. What else? Do you anticipate further stock market declines, or are we near bottom? I think we are near a bottom, although there's going to be some chop. Do you see more global rather than domestic investing in a strategy during this period? One of the things we did do for a lot of client portfolios leading up until, I guess, Liberation Day was put some capital internationally. And since then, we've carved that back. Couple reasons. The U.S. stock market has done pretty well over the last couple of years. Some of the international bourses have not done so well. Trump, once again, one of the best things happening for Europe in a second derivative fashion is it's forcing Europe to tear down its own trade barriers and walls. Like, for example, you're an olive exporter from Spain, and you have all your calories and the fats and all everything that goes into that jar of olives, right? But the Spanish FDA requires, or is maybe not as arduous, or maybe requires different labeling than the German FDA. So in order for me to export that can of olives to Germany, I got to repackage everything. It's got to be new disclosures. So now what's happening is it's forcing Europe to play with each other in a more communal sense. So I think there was an argument for that. We got to see what's going to happen once again as this 90-day window moves on. We got 2 more minutes, so let's take
I would
one
just
or
say,
two more.
Chris, I think with that, with those questions is here's the promise I think we want to make to the people here. And by the way, I'd love a thumbs up or a thumbs down, but this is such a volatile situation in terms of things that are going on, not only with the tariffs, but in the world, that we're committed until we get to a more, calm or stoic place to do these webinars on a very regular basis. And I think we're going to do it, not necessarily to say that we'll do it every week, but we may do it more than that, or even a little less than that. But anytime there's a little bit of light on the situation where we think we have something of value to add that can be something that would be actionable by you, and we want to get it out to the masses, I think we're going to try to communicate to you in this way for the next, through till we get through this issue. And the other thing too is that one is we just appreciate every one of you taking time out of the middle of your day. I appreciate all the people that are watching this on videotape tonight or the next day or the next week. And don't wait too long to wait it, because the information might be old. But we're going to stay on top of this. We are working day and night to make sure that we not only get through this in excellence but in elegance as well. And we will, and we are not disappearing. We want to talk to you, and we want to get back out to you as soon as we can with information that's pertinent. So, Chris, I want to thank you for all the hard work you did to prepare for this, and I just want to thank everybody here for taking the time to spend some time with us today. And we'll we're not going anywhere. We'll be here. Thank you so much. Thank you, everybody.